Hi, I'm Peter Switzer. Welcome to the program which puts you in touch with the best and brightest minds in the business. On tonight's show, so Medibank Private has been pitched as the Abbott government doing us the deal of the century, but is it? The former CEO and chairman of ComSec, Paul Rickard, has run his eye over the offering, so is this a great deal? Paul will tell us. Are our banks vulnerable because of their home loan lending practices, and should investors be wary of seeing them as the bluest of blue chips? We will debate this and other controversial topics with the AFR's Christopher Joy, and with the ANU copping some brickbats as well as bouquets for killing their investments in coal. We have Nathan Lim of Australian Ethical Investments to explain why ethical assets do so well. Stay with us for the next hour and we'll bring you all the latest corporate news and market analysis, plus learn some valuable lessons from Australian success stories. If you have any questions for me or our guests, email them to switzer@switzer.com.au, and you can follow me on Twitter, and the handle is @PeterSwitzer. But first, the Medibank Private float is the big news of the day. But is it a good deal for mum and dad investors? The man I turn to when I want a prospectus analysed is former ComSec boss Paul Rickard, and he joins me in the studio now. Hi, Paul.
Great, thanks, Peter.
I always feel a bit guilty by the fact that you do all the hard stuff, really analysing the numbers, and I get to tell the funny stories. And
you tell the jokes, right?
I tell the jokes. But I do read your very good analysis, and you've run your eye over this. Paul, what's your first impressions of this float?
First impression, Peter, is it's a little pricey. I was hoping it might be a little bit cheaper. So they're pictured at a price range, an indicative price range of $1.55 to $2. That's the maximum a retail shareholder will pay.
Right.
And on a forward multiple, at $2 it's 21.3, at $1.55 it's 16.5. Now 21.3 is a reasonably high multiple. Mm-hmm. And that compares to the listed NIB holdings at the moment, which is trading on a forward multiple of 18.6. So if it goes at $2, I think this is going to be pretty much at the top end. Yeah. And so I would have thought it may have come in just a little bit cheaper. So it'll be up to the institutions to work out the price, but my gut feel is just a little pricey.
So if people are registered and they go ahead with it, they'll actually have to send their cheque off before they find out what they're actually going to pay.
That's right. I mean, the way the whole process works is that as a retail shareholder, whether you get shares from a broker or you just go in through the normal public offer, you put your application in. They're due by the 14th of November. That's when it closes. The following week, I think it's between the Tuesday the 18th and Thursday the 20th of November. All the institutions end up and they have what's called a book build process, which is run by the joint lead managers. That then looks at where the demand from retail is, where the demand from the institutions is, sets a final price. Everyone pays the same price, with the exception that in the very unlikely event the institutions were super keen, the retail investors won't pay more than $2. Yeah. My guess is you won't pay $2. You'll pay less than that. And I think you'll need to make it leave a little bit of upside.
Yeah. Is it possible, if the instos being smarties, say that's a bit on the high side, lots of mums and dads might say, you know, this is like a good investment for me, and that could actually push the price closer and closer to $2 because the retail demand's so big?
A little bit. Two things should sort of happen. First of all, the brokers are sidelined because basically every broker's in the deal, so you're not going to get much fair insight from any of the brokers out there. Those who missed out, there's probably one or two will tell you it's pretty bad. Right? Those involved won't be saying much at all, aren't allowed to. Secondly, the institutions will probably start to talk it down. So you'll probably see a few fund managers come out and say, nah, this is not for me. And then the media will probably focus some other things. I've seen some comment around how much the CEO gets paid and all those sort of things. At the end of the day, they don't matter. Look, just judging by previous privatisations, and this is the first from a new government, and so that's probably one of the greatest things this IPO has going for it. It's the first out of the Abbott government. You would expect it should go reasonably well afterwards, but I think they've just been a little bit greedy, so I hope it's going to be talked down from an investor's point of view. From a taxpayer's point of view, you probably whatever.
$5 billion. $5 billion is good.
$5 billion, but I'm in the sort of talk it down school because I think it is a little pricey, and I think it needs to add just a little more value.
The analysis I did, and I didn't do as much as you, Paul, but it looked like the kind of dividend yield. Well, what did you work dividend yield out with and without the franking credits?
Yeah, look, I mean, without the franking credits, so on a on a frank basis, it'll be somewhere between 3.5% and 4.5%.
Right.
At $1.80, what I think it'll probably come out close to about 3.9% fully franked. So that grosses up to, just a bit over 5%. But, our bank shares are all yielding, 5.5% to 6% fully franked. Telstra's yielding 5.5%. So as a dividend play, it's not fantastic. But, it's a reasonably, what I describe as almost annuity-style business. Yeah. And you could argue that maybe you don't have some of the risks that you have.
I was going to say, well, BHP is a more risky company, only giving you a dividend around 3.5%, 4%. So I guess, this is a much safer kind of play, isn't it?
Yeah, I mean, this is largely a cost-out story.
Explain what you mean by business.
Because, I mean, it's basically a pretty mature industry. It's got reasonably good demographics in the sense that, obviously expenditure on health is increasing. Private health insurance, which makes up 90% of Medibank's revenue, they've largely been holding market share at about 29.5%. Yep. And the number of policyholders has been about the same. And each year revenues grow by about 5 or 6% because premiums go up, because health expenditure increases faster than GDP. So that's sort of the good news, and that's why it's reasonably describes almost annuity style of investment in some ways. But where Medibank has been, partly maybe because of its government heritage, maybe because of other issues, it's sort of the amount of money it pays on costs, salaries, IT, all those premises, is above the industry norm. And they've been working hard to reduce their costs, but even on next year's basis, forget what they pay out as insurance claims, but they're what they call their MER, or their management expense ratio. Still next year, it's forecast to drop from 9.2% to 8.7%. That still puts it a little above industry norm. So that's the opportunity for Medibank is really to drive the cost out a bit harder. Yeah. So that's one opportunity.
Well, Paul, but isn't there also, I've seen a number here, they get 3.6 cents in the dollar, where someone like NIB gets about 5 cents in the dollar, implying that it looks like a more costly operation. Yeah. And that's the blue sky.
That's largely the blue sky, and is for Medibank to take more cost out of the business. Yeah. And that's one part of the blue sky, and that's probably the bit they're focused on. And as I said, their cost base, what they're paying for, administrative expenses, not the money you get back as a claim, but the administrative expenses of processing that and marketing and all those type of things is above industry best practice. So that's the opportunity. Yeah. The other part of the sort of the upside for shareholders, potential shareholders, is that about 90% of their revenue comes out of their health insurance business. They have what's called this complementary businesses. That's about 10%. They're the market leaders with, almost 4 million customers. You've got to say there's a bit more blue sky potentially.
They could grow other businesses.
Well, they could grow other businesses.
Okay.
That's sort of the upside. And the downside is perhaps that, just to sort of give you the balance, it is, I think, pretty expensively priced. So, maybe $1.55 I like it. At $2 I think it's too much. Yeah. There's some challenges around their investment income, which are already factored in, and because they manage a lot of money, because that's what insurance businesses do, they get premiums before they have to pay out. They've got some challenges on their investment income. They have 29.5% market share. Their main brand, which is what we know as Medibank Private, has basically been flat for the last 3 years, and what little growth there's been in terms of number of policies has been coming in their AHM brand.
It's like an online...
bit like an online brand, and that's what's being sold through some of the comparison websites. So they're not actually getting growth in customers from their main Medibank Private brand. It's all coming out of their online or their...
And do you think the new world of online stuff could actually be a threat to these guys?
I think that's a bit of a challenge. And I think whenever you've got 29.5% market share, you've got some challenges. And then thirdly, this industry is heavily regulated. Now, governments do funny things. That can work both for and against you.
Yeah, that's true.
But there's a lot of regulatory risk here in the sense of, changes around how private health insurance premiums are controlled, whether the private health insurance rebate continues or whether it's expanded, a whole lot of other policies that impact this
Expanding would be good for Medibank, wouldn't it?
Expanding would be good, but probably unlikely in the short term. So I think you've got to balance that, and it's sort of almost annuity style, but you're paying...
Okay.
Pretty good dollar for it.
You're in, aren't you? I can tell you're
Government privatisation, you know,
always in.
Pretty well always in. There's only really been one dud of any recent memory, and that was the second Telstra. Yep. But pretty well everyone since then has done all right. I'm in, but I'm hoping it'll be a bit cheaper. Yeah. And I have to say, I thought they may have just priced a little bit too high.
Maybe you should come on the program, it's a dud to try and drive the price down. Now, before we go to break, Transfield, it got a takeover?
Yeah, Transfield Services got a bid from a Spanish conglomerate called Ferrovial. I can't say I know much about it, but I know they're a listed company in the
There's some impressive Spanish companies out there.
In the IBEX 35, and they've bid, put what's described as a conditional and sort of almost, you know, a bid from the directors of $1.95 on Transfield Services.
What was it listed at?
You're escaping me there because it hasn't been a good performer in the last couple of years.
It was under $1.95.
Yeah, it's been under a lot of pressure. That saw the share price jump 40 cents up to just under about $1.90. Now, the directors have dismissed it, saying, you know, we've actually had a lot better first quarter trading. We're going to tell
after a long bad period.
We're going to tell the market that at our AGM. I think it's the 5th of November. Yeah. You know, it's not high enough, but by the way, we're still going to keep talking to them.
So I remember many years ago, René Rivkin said always, well, mostly, the first bid won't be the last. What do you think? Is it going to work in this case?
It's probably unlikely the last. The interesting thing is the market hasn't put a premium on it. So the indicative bid is $1.95. It closed at $1.90. And I suppose if you look for the market action, you'd say if they really believed there was a lot behind this, then maybe they would have leapt the price higher. But you've got to expect that won't be their first foray. So watch this space. It is indicative. Maybe they're just testing it out to see what sort of reaction they get from both the market and also some of the institutions.
Okay, so you're not going to be rushing out and buying Transfield tomorrow?
Look, it hasn't been on my list of stocks. And look, I just think it's interesting, and pretty well some of those shareholders in Transfield will be almost welcoming that type of bid.
Okay, fantastic. Now, Paul's going to hang around because I've got Christopher Joy coming on talking about banks. And Paul, of course, was the former CommSec CEO and chairman, has been with CBA for a long time until he retired recently and wisely went to the Switzer Super Report. But he's going to stay on board and we have a nice little debate about our banks. See you after the break.